Namaste. In this video, we'll discuss about IND AS 113, that is fair value measurement. IND AS 113's objective are to define what the fair value is, set out a single framework for fair value measurement, and to discuss about the required disclosures in respect of the fair value management approach and techniques that we have adopted. Fair value measurement is a market-based approach. It is not an entity-based approach, or when we are evaluating a fair value or doing a valuation for any assets, liability or equity instrument, we need to think from the perspective of market, not from the perspective of the management. What management thinks, that is not relevant. So while doing the fair value measurement, we need to find out the market. So first we need to find out whether there is a observable market. If it is there, we need to use the data that is available in the market in respect of the valuation of the assets, liabilities or equity instrument. And if there is a non-observable market, observable market does not exist, in that case we need to find out what is the exit price for the assets, liability or equity instrument. In this case, we need to use the valuation techniques. And while using the valuation techniques, we need to maximize the observable input and should try to minimize the unobservable input while using the valuation technique. And purpose is to create authenticity and provide a valid fair value about the instrument. While doing the fair value measurement, we need to think about the participants' assumptions, including the risk. So again, here the management perspective is not important. Here we need to check what the other will thinks, what the risk other people, those are going to indulge in their transactions, or think about the assets, liability or the equity instrument. So entity's intention is irrelevant. Holding versus selling doesn't matter for the fair value. So here we need to see from the market perspective, not from our perspective. And here who cares that fair value cares for the market, not the entity's motive. So what the entity who is for whom we are doing the fair valuation is not important. It is important what the party who is going to buy, going to indulge in that transaction thinks about it, what the market thinks about it. So fair value is a market view, not my view. And there is a one framework we need to measure, disclose, and we need to forget about the intentions of the entity. So when we talk about the fair value, it is applicable when other indices requires or permit the fair value measurement. Index 113 doesn't tell when we need to use the fair value approach, but it is applicable when other indices requires to do the fair value measurement, whether it is a 41, 109, 16 or 105. And application of fair value measurement in AS 113 applies to both the when we are doing the initial recognition or subsequent measurement of the fair value of the assets or liability. So who case fair value rule stays for day one and day after. And there are some specific exclusions of 113. There are two types of exclusions. One is from the measurement and the disclosures. So it is not applicable on share-based payment transaction under here Ind AS 102 will apply. The lease transaction here Ind AS 17 will apply, and NRV to inventory and value in use in Ind AS Ind AS 36. So here if you see, these looks like that these are the fair value, but these are not the fair value. It is net realizable value and it is value in use. So both of these are also excluded from the purview of Ind AS 113. Apart from it, there are some exclusion in respect of the disclosures only, but the measurement will be done under Ind AS 113. For example, planned assets, the disclosures will be according to the Ind AS 19, but the valuation will be according to Ind AS 113. Apart from it, where recoverable amount is fair value less cost to disposal. So here also we are not supposed to disclose according to 113. The respective Ind AS will apply. So it is about the impairment. So if it has been already tested for the impairment, there is no double work that we need to do. So disclosures will not be according to 113. So if we here discuss that about the quick memory line. So scope, if other India says we need to apply the India 113, and there is a exceptions of 102, 116, 17, India 2, and India 36. And in respect of the disclosure, we need to skip 13 and 16. And this India's valuation rule apply either we are doing the initial fair value measurement or subsequent measurement of fair value of the assets or liabilities. So when we discuss about the fair value is the exit price, the price that we will receive by selling the assets or the price that we have to pay to transfer the liability to third party. So the key features of the fair value is that it should be an ordinary transaction. It should not be a forced transaction. It should not be a distressed sale. And it should be between the market participants. So it should not be with the related party. It can be with the related party, but it should be fair. So the basic trait says that it should be the buyers, the participants, the transaction should be independent, they should be knowledgeable and should be willing to enter into the transaction. It should not be distress or forced sale. Apart from it, it should be at a particular measurement date, should be at current market conditions. So here, if we summarize, fair value is today's market exit price. That should be orderly, not distressed. It should be by independent parties, not by me. What I think. So if fair value measurement of assets and liabilities, it is for a specific asset or liability. So we need to consider the characteristics of the market participant care about that asset or the liability. It is not what entity thinks. Entity's intention are irrelevant. Here we need to consider the characteristics of the assets and liabilities that market participants will take care when entering into the transactions. Apart from it, we need to check the conditions of the assets or the liability, whether for example, in case of the non financial assets, whether it is a old or new, it is a damaged or usable. Apart from it, where that asset is located, and the restrictions about the asset. So legal contractual limits on use or sale of the assets we need to consider when we are doing the fair value measurement of that asset and liability. So here the fair value is condition plus location and restrictions are the key parameters that we need to take care at the time of evaluating the fair value measurement. And there will be effect of the characteristics. Different traits affect the fair value only if market would factor them in. What entity thinks about those characteristics, it doesn't matter. If there are some characteristics, those are attached to the assets and liability. If the market take cares about those traits at the time of valuation, it will be considered. So when we are valuing the assets and liabilities, it can be measured whether it is standalone or as a group of assets. For example, cash generating unit or business. And unit of account fair value depends on whether we treat them as a standalone or the group. And relevant standard will decide what will be the unit of the account. So unit of account is not a choice of entity, but it is a direction from the accounting standard. So if we summarize it, fair value look at this item in its real estate and place. We have discussed condition, location and restrictions with the real time, and it can be one or many, but unit is set by the accounting standard, not by the entity. So while evaluating the fair value, we need to take care about the characteristics of the assets, and these characteristics should be considered by the market players. And how we will measure what will be the unit of account, whether standalone or group, it depends on the accounting standard. Next is the fair value, the transaction. So while evaluating the fair value, the core assumptions that it is an ordinary transaction. It is between the market participants, those are independent, willing to enter into the transactions, and it is a particular measurement date and under current market and conditions. So when this transaction is happening, where does transaction take place? There can be two types of market. One is the principal market, and principal market is where the highest volume and activity for the assets and liabilities occurs. And if there is no principal market, then we need to find out the most advantageous market for valuation of the assets and liabilities. And most advantageous market is market that giving best net result. So what is the best net result? It is the price that we are getting or we are paying minus the transaction cost and the transportation cost. So when we are so first we need to take look for the principal market, and if principal market does not exist, in that case we are supposed to go for the most advantageous market. So if principal market exists, although there is an existence of most advantageous market where we will get more benefit, we are not supposed to evaluate the fair value from the most advantageous market. We need to stick with the principal market if it is there. So summary is, go first where trade is most common. Elsewhere trade is most gainful. So if principal market is there, there is a highest volume, we need to value fair value from the principal market data. Otherwise, we need to go to the most advantageous market. And when we are identifying the market, there is a no need for the exhaustive search. We need to use reasonably available informations that we have. And normally the market in which we trade is called principal market. Suppose I am selling the assets in the Noida market, and most of the assets I am selling in the Noida market. So it will be a principal market for me because it is having the highest volume of the activities in a particular market. So if principal market exists, we must use that price that is available in the principal market, although the other market, most advantageous market, is more profitable. So we are not going to look after the most advantageous market if principal market is there, although the price is lesser. So hook is that principal beats the profitable. Next is accessibility to the market. So entity must have access to the market, whether it is a principal market or most advantageous market. Different entities may have different market for the same assets and liabilities. So we need to check where we are selling. It is important where entity is selling its goods, that is a principal market for it. Another entity may have a different principal market for it, and you don't need to actually sell or transfer on that date. When we are measuring the fair value, we only need to have the access to the market. Actual transactions happens, it doesn't matter. Only the entity whose assets, liability or equity instrument is going to be valued for that particular uh, period. So that entity should have access to the market. And if there is a no observable market, in that case also, we need to assume a hypothetical transaction at a measurement date from the perspective of the market participant. So there may be some transactions, some non-financial or financial assets where the observable market does not exist. For example, if there is a case of specialized PPE, for example, airports. GMR is having airport licenses. They are owning the airport. So if they want to sell the airports, there is no observable market exist. So we need to use a different techniques, valuation techniques to evaluate these assets. For example, another is power plants, telecom spectrum rights, mining rights, complex financial instruments like convertible preference shares, CCD, and structured derivatives where shares are not traded. Hence, there is a lack of observable market. So we need to use different techniques or need to create hypothetical transactions. We need to imagine the market if we cannot see it. So in respect of the fair value, next characteristics is market participants. So core principle about the market participant is that fair value is measured using assumption that market participant will use. This is not management's personal view. Market participants always act in their own economic best interest. So in that case, we need to use the same assumptions that what the third party will put a price for my asset or a liability. So we need to think like a market, not what we think. Here we need not to name specific market or buyers or sellers. Instead, we need to think general characteristics of the market participant in that market that they will consider while evaluating our assets or liabilities. For example, what is the nature of my asset? What the risk that asset or liability carries? What are the restrictions on the assets or liability? For example, I am having a piece of land, and if there is a restrictions on that land that it cannot be used for the commercial purpose. So when we are using the valuation of, when I'm doing the valuation of that particular land, so that restrictions regarding the change in usage we need to consider. Apart from it, we need to check the relevant market principle or most advantage market and traits of the buyers and sellers in that market. They should be independent, knowledgeable, and willing to enter into the transaction. So, who cares? First, we need to check about the characteristics, nature, risk, and restrictions of the assets. Then we need to look after the market and then the players. Next is the principal market that we have already discussed. This is the market that is having highest volume and activity for the assets and liability. And if principal market is there, we are not supposed to go for the most advantageous market. And if there is a lack of principal market, then we need to look after the most advantageous market, and it is having transactions that give the best net result after considering both the cost, that is transportation cost also, and transportation cost, transaction and transportation cost we need to consider here. And the transaction should be orderly transaction. It means that is not forced. For example, not liquidation or distress sale is there, and both the buyers and sellers are willing and knowledgeable to enter into the transaction. So what is the price? What is the fair value? That is the exit price. Price to sell the assets or transfer the liability in orderly transactions in principal market, or if principal market does not exist, in the most advantageous market as a measure at a measurement date under current market conditions. So my assets should be there in the market to get the transaction done, and the exit price should be directly observable or estimated. So line is that today's market exit price, how much I will get after selling the asset in the market, whether it is a real market or estimated market. So that will be called a fair value exit price. Transaction cost, fair value exclude the transaction cost, that is brokerage, commission, legal fees, etc. So the question arises, why transaction costs are not considered at the time of fair value measurement. So the answer is that transaction cost belongs to the deal. These transaction costs are not specific to the asset and liability, and transaction cost vary by how and where transaction is done, and such costs are dealt by other indices, not by the fair value standard. So hook line is that fair value is asset focused, not the deal focused. So transaction costs are always considered as a deal charges. It does not reflect the fair value of the asset. And this we will discuss in detail in next slides. Next is the transportation cost. It is not same as the transaction cost. So if the location matters, the fair value price should be adjusted for the transportation cost to move the asset to the market, because if we check the definition of the fair value, it says that it is a price to sell the asset under current market and conditions. So quick memory line is fair value is the exit price. We are not supposed to consider transaction cost, but we need to adjust for the transport if location matters. So in case of transport cost, fair value is always measured in the principal or most advantageous market, because transport cost is inherent to the location of the asset, because as the fair value says that it is exit price under current market conditions. So for example, if iron ore are in Odisha mine and we to sell the ore, we need to reach to the market, whether it is a principal or advantage market. For example, market exists in Kolkata, so ore must be transferred to the Kolkata. In that case, we need to consider the transportation cost, because it is a necessary condition to get the transaction done in particular market. However, in case of brokerage and legal fees, these are the cost of executing a particular deal. Share, bond, land already has a market price, what a buyer will pay. But the brokerage and legal fees is about your choice of intermediary, not the asset itself. So brokerage does not matter, does not affect the fair value of the asset. It is just an intermediary cost to get the deal done. So it is a deal specific cost, not the asset specific cost. So this is a difference. This is a difference in the nature of the both of the cost. Transportation cost is inherent to the location of the asset, but the brokerage is a deal cost. Similarly, if we think about the comparability of the both the cost of transaction and brokerage, transport cost under Ind AS 113 says that fair value is the price at assets current location and condition. If all the buyer are in Kolkata, everyone must transport to the Kolkata, so adjustment is consistent because the market price is determined in Kolkata, but we adjust it by subtracting the transaction cost so that the fair value reflect the orange worth where it currently is. Similarly, in case of the brokerage, different seller might use different brokerage. It may be 1%, it may be 0.5%, and in online trading, it may be 0.1% also. But fair value would vary person to person, not comparable. If we include the brokerage, in that case, the fair value of the asset will vary person to person and it will not be comparable. That's why, because of the it will reduce the comparability of the fair value. So we are not going to adjust the brokerage, legal fees, etc. So let's discuss some examples about it. For example, there is a equity share that is listed. Fair value of the Infosys share on NSE is 1500 and we need to pay brokerage of 1%. So here the fair value will be 1500, not 1515, because the brokerage depends on your broker. Fair value should be same for all the investors, because fair value is what that is exit price. So exit price of at NSE is 1500. So we will consider 1500. Brokerage may be different based on the agency. Similarly, in case of the mutual fund, NAV is 200 per unit and AMC charges are 2 rupees per unit. So here the fair value will be 200. Logic is that entry load is deal specific. The units value is NAV only. Similarly, next example, if we check, there is a corporate bond, the fair value is 1000 rupees and underwriting commission is 30 rupees per bond. So here again the fair value will be 1000. We will not consider the underwriting commission because it belongs to the transaction, not to the bond. What is the underwriting commission? How much it is? It will not change the fair value of the particular bond. That's why we are not going to adjust it. Similarly, there is a land in the Delhi, the buyer offered 2 crores and apart from it seller pays stamp duty of 8 lakhs. So we will consider fair value as a 2 crore because stamp duty is a legal requirement of the transaction, not inherent to the land price, and it will not impact the pricing of the land. Similarly, if there is a crude oil refinery and local buyer price is 6000 per barrel and distant Mumbai market price is 6,200 barrels, and transport cost to Mumbai is 300 per barrel. So fair value, for example, the principal market is Mumbai market. In that case, we need to bring the crude oil to the Mumbai market. In that case, we need to reduce the transportation cost to that market. So it will be 5,900. Transport is included because asset must reach the market. That is a basic condition of fair value. Next example is coil from Jharkhand mine. Price at not quoted, and price at Kolkata market, that is a principal market, considering it is a principal market, is 4,500 per ton, and transportation cost is 500 per ton. So the fair value will be considered 4,500 minus 500, 4,000. And logic behind it, that market exists only in Kolkata. So we need to include the transportation cost while calculating the fair value for the coal. And in case of agriculture culture produce, wheat fair value at mandi, principal market is 2,000 per quintal. Farmer must transport to mandi 100 rupees per quintal. So the fair value will be 1,900, 2,000 minus 100. So logic is the fair value reflect price in principal market less the transportation cost, and brokerage etc. will not be considered. Transaction cost will not be considered because it does not affect the fair value. But transportation cost does affect the fair value of the asset. So we need to consider the transportation cost, not the transaction cost. So next is when we are applying the fair value approach to non-financial asset, we need to check about the highest and the best use of those financial assets. So what is the highest and best use? That is the maximum benefit to the market participant by these assets, either by using it or selling it to someone else who would be beneficiary. So there are three conditions for the highest and best use: that physically possible, what is the location of the asset, what is the size of the asset, and if there is any physical limit about the assets, and the uses should be legally permissible. What is the zone, regulatory restrictions, we need to check about the assets, and the financial feasibility, adequate return after the conversion cost, etc. So we need to look about the 3P: what is the possible, permissible, and profitable. So this highest and best use we need to determine again the same principle from the market participants view, not the entity's view. And we need to presume the current use as a highest and best use unless market shows otherwise. For example, I am having a piece of land on which I am running a school. So for me, for entity, that is the best use. But the market participants thinks that they will get the usage of land change, and they will create a very good complex over there. So the best use will be the complex, because we need to think about from the market perspective, not the owner's perspective. Even if entity intend not to use that asset actively and they want to use defensive intent, for example in case of intangible asset, so fair value will be the highest and best use what the market participants think about. So who cares market's best use is above my silent use. So next is the valuation premise. So highest and best use set the valuation premises. For example, in combination with other assets or liabilities that creates the synergies. For example, if we are measuring the fair value of a business, whether it is a standalone basis or combined basis, it will be the same because the synergies flows to the market participants. Let's see in detail. When we are valuing the business, its fair value is the same whether you view it as a standalone or in combination with the other assets and liabilities. Because the market participant, what they will think when they are evaluating a market, they will think that it is going to be a going concern, they are going to earn the money. So the property, plant, equipment, and the liabilities will be the part of the fair value inside the business, but Point here is that at the business level, synergies belong to the buyers and they will evaluate the fair value with all the PPE, liabilities, etc. So they will create a fair value for the market, for a business, sorry. Next is when we are evaluating the fair value of the machine, it is a observed price plus installation, transportation cost. So it reflects the real usage condition of the machine. It is not the fair value, the price of the machine at which it is available in the market, but we need to check to make that asset usable, how much cost we need to incur. So that will be the fair value of the machine. So it will include the installation cost, transportation cost also. So sometime a non-financial assets depends how this asset is used with other. So we need to adjust it to reflect the fact that in reality the machine is installed, configured in a business. For example, company Y buys a packing machine. The standalone price is 50. But to make it usable, I need to spend the transportation cost, installation cost, safety integration, and so the total these three costs will be 6 lakhs. So the fair value measurement will be at 50 lakhs, the purchase price, and the price that I need to pay to make the asset usable. So it will be 56 lakhs. So logic is that market participants don't just buy machine in a showroom. They buy them ready to use in a business condition in business. So therefore, fair value reflects the current condition and location that it is installed and operation. And we need to do the adjustment to bridge the gap between the market observable price and economic reality of the usage. Next is about the WIP. WIP is unfinished goods. So fair value assumes that buyer have to obtain machine or need to convert this work in progress to the finished goods so that it can sell in the market. So we need to add the additional components to convert the WIP to the finished goods. So we need to take care about the conversion cost in this case. So let's take one example that company Z manufacturing pharma drugs and they have the WIP inventory, half processed chemical compounds. On its own, this WIP has no ready market available. So we need to convert it into the finished goods market so that we can sell and can get the money from out of it. So market participant would assume that they already own the specialized equipment needed to finish the component into tablet. So finished good tablet sells as rupees 10 and the cost to finish is 3. So fair value of WIP is 7. So fair value assume use in combination with other assets or machinery. Even if machinery is not currently held by the seller, in that case, we'll assume how much cost we will incur through the third party to get this WIP converted into FG. And next is about the intangible assets where some specific techniques are used, multi-period access, earning methods, etc. So when we evaluate the intangible asset, we include the contribution of complementary assets and liabilities. Here we think that intangible assets cannot provide the value independently. So in case of intangible assets, we need to think about that. For example, there are customer relationship, brands, and technology. So when we use the different MPEM technology, it required deducting the contribution asset charge for all the supporting complementary assets that are attached with the intangible assets. For example, suppose company Q is valuing its customer relationship. So customer relationship is not something that standalone has its own fair value. There are some other components also that contributes to create the customer valuation. So there is a, for example, there is a sales team that is helping you to create the customer relationship. That is, there is a product lineup, R&D, and the other working capital to serve the goodwill to create the customer relationship. So in this case, for example, forecasted cash flow from the customer base is 100 crore over the life, and we need to deduct the contributory asset used in combination, for example, plant and machinery, workforce, working capital. So the total contributory asset is 35. So the residual 65 will be the fair value of the customer relationship intangible. So here the technique itself forces recognition that the intangible cannot generate value without the supporting complement. So when we are valuing the intangible, we need to remove the cost element of the supporting complementary assets. Next is property allocation. So fair value of improved property is allocated between the land and improvements. There are the cases where there is a combination of the assets. In some limited cases, you don't measure asset fair value directly. Instead, you value complete assets. For example, we are having land, building, and improvements. So we find out the fair value of the combination of the assets, and after that, we allocate the fair value to the different components. So let's take one example that company are on a improved property, land, factory building, fencing, and landscaping. And here the market transaction, a comparable property is sold for 120. So we need to allocate the amount between the three components. So 60% they have allocated to building based on the techniques that they have used, and land similarly for the fencing. So here the principle is that instead of finding separately fair value of land and building in isolation, we need to find out the fair value as a whole property and then need to allocate it. So this is when we are doing the valuation in the combination of other assets. And second technique is on a standalone basis, that is independent use when an asset liability is having. So fair value is the price to sell to a buyer who would use asset individually. For example, vacant land if we have, so that land will be evaluated on its own separately. Next is the hierarchy for measuring the fair value for the liabilities and on equity instrument. So first is when the liability and equity is transferable and is identical item that is held as an asset by the next party. So the mirror exists for the valuation of the liabilities and the equity. So in this case, we need to use the market participant holders perspective to evaluate the liability or the equity. So in this case, if a quoted price is there, so we need to use the active market for the identical asset. For example, are the bond issued. Company A issued debentures 10,000 of face value of 1,000. So those bonds are traded at NSE at 1050. The debentures are issued at 1,000, but the trading at exchange at is 1050. So this debenture is a liability for company A, but for investment for investor it is an asset. So the fair value will be the traded price at the NSE, National Stock Exchange. So it will be calculated 10.5 crores. Next is ordinary share. Those have been issued. That is an example of equity instruments. So company B is listed and its share trades in BSE at 250 per share. So for B, it is an equity, but for the investors, it is an asset. So as we have seen that we need to use the market participants holders perspective. So the holders value is 250. So it will be fair valued at 250. Next is publicly traded preference shares. So company C issues preference shares. Those have been classified as an equity, and these shares are actively traded at 120. So from the market party holders perspective, the value of the asset is 120 per share. So the here logic is the fair value must reflect the exit price. So in all these three cases, if the holder exit, it will get here 1050, here 250, here 120. So it will be the fair value of the asset. And if it is asset is actively traded, there is no need to use the any other model or estimate, and we need to use the observable quoted price only. And in case if there is a no active market, so we need to use the quoted price in the inactive market. And what is the inactive market? So let la- learn from the example. So if there is a no active market, we need to look after the identical market for instruments. For example, quoted price in inactive market where trade happens but infrequently or very in small volume. So here, for example, bond issued by the company that is inactive in the market. So company X issued bond. They used to trade actively, but now they are not trading. The transaction is very less. And last observable trade shows that there is a price band of 980 to 990. Though not from an active market, but this is a observable price can still be used for measuring the fair value. Next example is private company preference shares. Those are classified as equity and these are not listed, but similar preference share of comparable companies, those are having yield of 10%. So the fair value if we calculate it will be 105. So here there is a no active market, but we need to look after inactive market. We need to look with the comparative companies and need to adjust the value according to the traits of the assets or liability that we are having. So this is about the loan payable. Company Z has a loan from the bank and loan is not traded, but market observable input new loan from the similar risk profile is priced at 12%. So we need to discount the future cash flow at 12% to come upon the fair value of the loan liability. So here logic is that if level 1 input, that is quoted active market, is not available, we need to look after the inactive market. So we need to use the closest observable evidence from the market participants. It may be inactive market, similar transaction, benchmark, etc. And need to keep the valuation still grounded in the market data. We need to make the valuation as much possible as authenticate. So next is if there is no quoted market, quoted price, or there is a no active market, so we need to use different valuation technique. For example, income approach, here we need to calculate the present value of future cash flows, and market approach where prices of similar liabilities and equity instrument we need to check for the valuation purpose. So if this is an example of income approach regarding the ESOPs, company B grants ESOPs, those are not traded. Fair value is measured using the option pricing model based on the assumptions about the volatility, risk-free trades, and expected life. So there is a no direct market, so fair value will be derived from the expected future benefit to the holders by holding those ESOPs. And second is the market approach for unlisted preference shares. So company she issues preference shares. Those are not actively traded. There is no active market, but similar preference share of the comparable companies trades at yield of 12%. So we need to adjust the difference. The fair value of company C is derived based on that. So logic is when direct price are not there, we need to step down the fair value hierarchy and we need to use either the income approach where we need to calculate the present value of the all cash flow that buyer would expect, and in case of market approach we need to look at the similar transaction and need to adjust it according to our assets liability or equity instrument. So here we need to ensure that fair value still reflect the exact price perspective of a market participants. So as we have discussed that we need to adjust the price if the asset is not identical or unit of account differs. So examples are credit quality different and or the asset price reflect combination combined package. For example, there is a instrument that is having liability plus credit enhancement. But the liability fair value must exclude the third party credit guarantee if liability does not carry the guarantee. So here, for example, one instrument is there with the credit guarantee, one instrument is there without credit guarantee. So we need to adjust to make them identical for the purpose, because the instrument with the credit guarantee is having the more value. So we cannot compare it with the instrument that is not having the guarantee. For example, there is we have issued a bond that is rated triple B, and has the price for band B. For this bond, there is a no price. There is a price available for bond B, and that is having rating of AA. So we need to downward the value of bond A because its rating is lesser. So it carries a higher risk. So next example is for the unit of account differs. For example, investor hold a bond plus third party guarantee package. So this price is quoted as 1100, but our liability is only the bond without guarantee. So in this case, the price will be lesser. So we need to adjust for this guarantee package and the price may be at 1000. Next is, in the first case, the mirror was there. So the quoted price was available. But in this case, liability and equity are not held by the uh, holders as an asset. So there is no mirror exist to check the price of the asset. So here we need to think from the perspective of debtors and what they expect. So here we need to use the valuation techniques, present value and entity price approach, where the amount a market participant would receive to issue identical liability or equity with the same credit characteristics in the principal or most advantageous market. So here we need to use the valuation techniques and to use the debtor's perspective to find out the fair value of the liabilities or the equity. For example, if no one holds them an asset, there is a no market code. For example, decommissioning liability, litigation provision, warranty provision, some performance obligation in contract, or equity classified instruments. So these are not trade. These are the instruments. Those are not having market. So we need to find out what price we need to pay for these instruments. For example, decommissioning liability, there is a no investor hold this as an asset. So we need to measure the fair value by estimating the cost a market participant would charge to assume the obligation. For example, dismantling cost is 50 crores. So we need to add the 50 crores plus the risk premium that he will ask from us. Similarly, for the warranty obligation, there is a no market exist and fair value measured using expected cost approach. For example, 1000 products are sold and there is a 10% expectation of failure. So the average repair cost will be 5000. So we need to adjust it for the risk and discounting. Similarly, for litigation liability, it cannot be held as an asset. So fair value will be probability weightage, cash flow of the expected settlement, and we need to discount it. So logic is, if the liabilities, equities are traded as an asset like bond, share, options, we need to use the market codes. And if they are not traded, in that case, for example, like provisions, unique obligations that we have discussed, decommissioning liability, litigation provision, etc., we need to use the valuation technique to evaluate the fair value. Similarly, in case of non-performance of asset, we need to include on credit risk and other non-performance factors while evaluating the assets. So, fair value reflect the issuer's credit standing. If credit enhancement is inseparable and separately accounted, we need to exclude it. We need to only account for credit risk. For example, fair value of liabilities reflect the non-performance risk on risk. But if there is a third party credit enhancement like a guarantee or insurance, and it is inseparable but it is accounted as separately. So we are not supposed to include the effect of the liability. Liability fair value must reflect only the issuer's own credit. Why? Because the unit of account is a liability. We are evaluating the fair value of the liability, not with the guarantee package. So if the instrument is inseparable, so but accounted separately, in that case we need to look after the liability alone, not with the credit enhancement instrument. For example, loan, there is a example of loan plus credit insurance, that company B borrows 50 crores and lender take out the credit insurance from insurance Y. Fair value of loan liability from company B is based on the company B's credit standing only, not insurers. Insurance is accounted for separately by the lender, not by the company B. Similarly, warranty obligation with the insurance, here also warranty obligation will be based on the company's ability to meet the claim. That is a non-performance risk, and insurance contract is a separate asset that will not be netted against the liability. Next is about the restriction of transfers that we need to ignore, because at the initial recognition of initial measurement of fair value, we have already considered it. So there should not be double adjustment to at a measurement date. And next is liability with demand features. So it cannot be less than the amount that we are going to pay. For example, debentures value is 100 rupees, we need to pay 100 rupees. So fair value cannot be lesser than 100 rupees. So here, if we check that prior about the priority flow, first, if mirror asset is available, we need to check for the quote price, else we need to check for the valuation techniques, and we need to always reflect the non-performance risk, and we need to ignore the transferable restrictions and look after the demand features rules. So fair value can be measured on a net exposure basis for the group of financial assets if entity is managing on a net risk basis, and there is a documented strategy for that, and there is a reporting mechanism to key managerial person on that basis, and items measured at a fair value in the balance sheet and applies only to IND AS 109 approach. For example, if uh, a bank hold derivative assets of 100 and derivative liability for 90, so net exposure to the market is 10. So instead of measuring each separately, bank can measure both assets and liability on a net basis of 10. But it is allowed when there is a risk basis is as per the document strategy, and there is a reporting pattern for the KMP. Next is the company A has receive fixed and pay floating swap, and pay fixed, receive floating swap. So in that case, the asset value is 50, liability is for 48. So net exposure we can measure at 2. So exit price for these two asset position and liability position will be at an exposure of 2. Similarly, credit risk rating, bank B enters multiple derivative contracts with counterparty Y, some in the asset position and some in the liability position. There is a master netting agreement exists with the Y that it can net both of the assets as well as the obligation. So in that case, we need to value on a gross basis. So we can net the assets and liabilities instead of reporting them separately. So next is the risk exposure. We need to net the fair value measured using the price within the bid ask spread that is most representative of fair value. So market risk must be substantial same. Duration of the exposure should be aligned. For example, the debenture with a 1 year maturity should not be compared with a debenture of 5 year maturity. We need to measure apple to apple. Similarly, counterparty credit risk we need to reflect at the time of exposure calculation. Consider enforceable arrangement that is master netting collaboration, collateral, and reflect market participants' expectations of enforceability. Similarly, at the time of initial recognition, transaction price, that is the entry price, is not necessary that it is fair value. That is, it is exit price also. Normally, the transaction price is the fair value, but there may be some cases where the entry price is not the fair value. So often, but not always, fair value is not equal to the transaction price, and Indians require fair value recognition. We need to recognize in the profit and loss where there is a gap, or unless or other Indians says otherwise. So let's take one example about it. For example, company D gets equipment for rupees 10 lakhs under a government grant scheme. So this is a transaction price that they have received this equipment at 10 lakhs. The fair value of the equipment is 15 lakhs. So the difference we will not recognize in P&L because this is received at a lesser price under a government grant scheme. So we need to book as a government grant as per India's 20. So there are some other examples where the transaction price is not equal to the fair exit price. So transaction in market other than the principal or most advantageous market unit of account mismatch is there. Some bundled versus individual related party transaction cannot be said at fair value unless otherwise it is proved. And distress forced transactions, those are not orderly, cannot be on fair value. And abnormal market condition if exist, so it cannot be called as a transaction price cannot be equal to the fair value transactions. So this table gives a priority flow that we need to check out the mirror assets availability. We need to use the quoted price as valuation technique and reflect the non performance risk, and we need to ignore the transfer restrictions and demand feature rules will override. Oh, sorry. So if we check about the valuation techniques and the input, so choice of valuation technique, we need to use the technique appropriate with the sufficient data. We need to maximize the observable inputs and should minimize the unobservable inputs. And that is common is market approach, cost approach, or an income approach. So the memory tag is that we need to use the right tool for the right job. And calibration at initial recognition, if fair value is equal to the transaction price initially. So in case of calibrate model, so that it equals the transaction price. So if the calibration is required to check the to come on the correct fair value, we need to do it. And there should be consistency. Technique that we have used to measure the fair value must be applied consistently unless or otherwise change represents that is more useful, and it will be treated as a estimate change as per Ind AS 8. And the journal input principle is that maximize the observable input, and input must reflect the characteristics of the assets and liabilities. Blockage discounts are not considered here. And bid ask conversion, use most representative price with the bid ask spread, and it can use mid market conversions, and that is middle of the spread. Fair value hierarchy, we need to use the level 1 input, then should go for the level 2 input and 3 input, and we need to classify by the lowest significant input. So in case of level 1 input, it is source of information is quoted price in active market for the identical assets. Examples are share traded on stock exchanges, government bonds in liquid market, and there is generally adjustment are not allowed. So these are the most reliable and most used if available, and label 2 is observable input other than label 1, directly or indirectly. And examples are quoted price for similar assets, because the assets for which we are doing the fair valuation is not available. So we need to use the similar assets, and in that case, it will be defined as a level 2 input. Inactive market quotes, interest rates, yields curve, and credit spread. So we need to do the adjustment. So this bridge the gap between the combined market data and need to do some adjustment. And level 3 is unabsorbable input. So entities on assumptions is used. So it is less favored. So here it is private equity, fair value, and specialized intangibles, etc. So here also we need to do the adjustment. So this is the least reliable and highest judgment and uncertainty involves here. So this is all about the IND AS 113 fair value measurement. If you have any questions or have any suggestions, please contact on the WhatsApp number or comment on the video. Namaste.